morning, I'm Chris Beecham and welcome to Charting the Markets on IG Live. And of course, we're back at the earnings season once again, not the start, but if you like, the resumption of earnings season after something of a break over the past week. And of course, it's Netflix earnings taking center stage tonight. Beautifully timed, of course, with US markets, Dow, the S&P and the Nasdaq all sitting at record highs. So as we go into the real busy period of earnings season, we had the warm up from the banks, but the busy season period for earnings season really starts now. Netflix, Tesla, and then next week you get the rest of the Magnificent Seven reporting and a whole host of other companies. So it certainly comes at an interesting time for US markets. The main real driver overnight, Bank of Japan, unsurprisingly, did what they always do for the time being anyway, and left policy unchanged. They said that deflationary attitudes were taking hold in Japan, and whilst their next meeting is in mid-March, given that wage negotiations in Japan will still be going on until late April, there's probably no sign of any policy change until the end of April at the earliest, which means we're still seeing strength in the dollar versus the yen, indeed further strength in the Nikkei, certainly not much downside for the time being. And then in commodity prices, seeing a bit more strength coming through in crude oil prices yesterday as well, which is interesting, maybe finally indicating signs of a substantial move to the upside, at least in the short term, after what has been a very choppy period of trading for oil prices. But let's start with indices. Let's start with the Dow, currently trading at 37,994, just below 38,000, just off the record high we saw yesterday. And of course, what we've seen in the Dow over the past 3 months is an indication of how far trends can go in one direction when they really want to, because you've had an index that has gained 5,500 points from the October low. Let's just put that, think about that for a second. 5,500 points after that breakout, after that rebound from October lows, and then the breakout to the upside in November. And since then, it did consolidate from the second half of December as liquidity dried up ahead of Christmas, and then over the new year, and then into maybe some caution around earnings season. Lo and behold, you had the index consolidating, but that was all we got. And this is the thing, I think a lot of people have looked at this rally in November and December especially and thought, well, it's due a pullback at some point, but we haven't really had one. All we've had is that 1,000 point or so drop back. Not even that, of course. About, say, 700 points downwards move in the middle of January. But consolidation rather than pullback, which should send a message really, at least for the time being, about the strength of this trend. This is a market that does not yet want to go down. The sellers have not got the strength to push this one lower. You've had breakout after breakout here. You've had breakout from trendline resistance in November that's carried on. We've had the breakout, of course, if we zoom out, see where we were, the breakout in mid-December above previous record highs, and that sends a message that the buyers are very much in control here. And the fact that all that the sellers could manage was a pullback down, not even towards below previous record highs, sends a message that there's plenty of strength in this market for the time being. I can hear you saying, yes, but it's earnings season, and that might make things go down because markets are already on a high, good news is being priced in. Yes, that's a possibility that we should be open to. But at the moment, there's no sign of that developing. So we'll see how earnings season fares and whether that does begin to push the market lower. That said, of course, it might be somewhat late to the party if we think you're buying it now. It has to be said. So you should be prepared for the possibility that indeed over the next 2 or 3 weeks with earnings season really hitting its stride, what you get is a lot of sideways volatility, but not much progress. The market will continue to digest because swiftly after earnings season we get the Fed meeting in January. So there's plenty of macro events on the agenda, but certainly at the moment it's hard to muster up a bearish view at all. The fact that it's held firmly above 37,000, not even testing the previous record highs, sends a message here. And if it did pull back, of course, down towards the 50-day moving average, that might yet generate another leg to the upside in due course. So firmly uptrend firmly in place here for the Dow. For the Nasdaq as well, record highs. It's a bit of a refrain for US indices at the moment. Slightly more two-way action in the Nasdaq so far this year. You certainly opened the year with a drop over 4 or 5 sessions, which nonetheless still left it more than 2,000 points higher from where it was at the end of October. So in some ways, this looks a bit more healthy in the sense it hasn't just gone up and then consolidated. It has had at least a form of pullback. It's not a huge pullback, but barely 5%. not into correction territory at all, but certainly just taking some of the froth off the index, if you like, and then another leg to the upside. So very noticeable that the buyers have wrested control of this one once again, taking us to record highs. Same thing applies, of course, for the Nasdaq as the Dow earnings season, particularly so for the Nasdaq really over the next week or so, because Netflix today, Tesla tomorrow, and then next week you've got Meta, Apple, Amazon, Alphabet, Microsoft. The rest of the team will be reporting, and that has the potential to really cause at least some two-way volatility, as the stocks themselves might get hit on their because of their recent strong performance, if nothing else. But at the moment, the index sitting quite happily at the record high. It established that higher low earlier in January around 16,300. So the buyers still firmly in control here, and no sign of a more substantial pullback developing for the time being. There's a lot of focus, of course, on the Russell 2000 and commentary around the fact that it's not at a record high, which is fair enough. It's not. It's underperforming. It's been left behind by a host of other indices, and there's always the view that because small caps are viewed as a good indicator of risk appetite, because they're not joining in, therefore this rally isn't strong. Essentially, there's not much strength to that view, really, I think, to be honest. If you look at the market cap of the Russell, it's now the fact that the Magnificent Seven, the big 7 tech stocks that are reporting over the next week, their market cap is 4 times, or was, I checked about 2 or 3 weeks ago, it was 4 times the entire Russell 2000 index. So that's why they're more important, simply because they're bigger and more capable of moving the market. Nonetheless, let's talk about the chart rather than getting in my soapbox about small caps. Here, again, even more of a dramatic two-way move. So this is perhaps more of what you'd want to see in an uptrend. You could argue that you had the big move high, yes, but you also had a decent pullback, which for the Russell was about 9%, just shy of 9%. So a more substantial pullback, which some people might say helps to reset the index. And you had the textbook drop to the 50-day moving average, the rising 50-day moving average. Now, of course, above the 200-day once again. So you could argue that's firmly in uptrend territory. And you've got the price now rallying. You've gained about 100 points in the space of a week, really. So the buyers, again, even in the Russell, which is not the strongest performer, showing plenty of strength. It's notable, I think, that if you look at the price action since August on the Russell, that this big area around 2000 held back the index 3 times since August of 2022, in fact. The last time we were here in the summer of 2023, there was that huge drop in the Russell 2000, I remember it well. But notably, we broke above it in December. Yes, we broke back below it in December, in the beginning of January as well, as that weakness took hold in indices, most pronounced in the Russell. But previously, where you've had a pullback from 2000 that then continues lower, this time around it was different, to borrow a phrase. You dropped back down to 1900 and the rising 50-day moving average, and it consolidated, and then it moved higher. So it is different this time from what we'd seen, sorry to keep zooming in and out, more from what we'd seen since August of 2022, namely that the price this time didn't want to keep going lower, and we've seen a rebound back to 2000. Could see some volatility around this once again, but a move back towards 2080 and those highs from December still look very, very likely. Looking longer term, see where the next big level to the upside is. The nice thing about the Russell, I suppose, you don't have to go back quite so far to find the next level to watch. But above 2000 and 2080, then perhaps around 2106, and then finally the March 2022 peak at 2140 is the area to watch for this index. Looking to FX markets, it's ECB week, so euro-dollar is always going to be choppy at best. And it's still doing its level best to try and consolidate around the lows of last week, because you had to test the 200-day moving average on Wednesday and Thursday. The price so far unable to break the high, and that's the key thing to bear in mind. Notably this morning as well, if you look over the course of the first half of January, the 109.20 area provided a degree of support for the price. Now we've broken below it. Axel's always a fan of what he calls inverse polarity, where support becomes resistance. That's exactly what you've had so far today. Price attempting to get back above 109.20 and failing. We're also now consistently below the 50-day moving average, so it tends to send maybe a short-term bearish message. That said, it's still, as I said, but there's always something else you can say, but there's still possibly a higher low being formed here. We thought that was the case, I suppose, in early January, and then you had the drop in mid-January that took us below the 50-day. So maybe there's yet chance of higher low being formed here. If we were to just redo this trend line, that trend line at least is still yet to be tested. So as long as it's holding above there, you might still argue there's a hope perhaps of a more bullish move for euro-dollar, perhaps if the ECB come out on Thursday and are a tad more hawkish, because I think of all the central banks that we focus on, if you look at the Fed, BOE, the ECB, the Bank of Japan, it's the ECB that appears to be the most reluctant to even talking about cutting rates, to borrow a phrase from Jerome Powell. At the moment, they are adamant they need to do more, and there's no hint that they will start changing policy. So if they are sort of beat the drum for the need to remain restrictive, that might give euro-dollar a lift to the upside. So it's the kind of week where price action, of course, is vital, but it's a week where the macro, the headlines could intervene to change things. So do watch this one for the time being. Still quite under a bit of pressure, euro-dollar. We'll see how that plays out. Looking over to Asia, and here's a very interesting one because Chinese markets very much in focus over the year so far. I say that over January so far, perhaps better to say, mainly because of the real poor performance of the Chinese stock market, especially the Hang Seng, which is rapidly moving back to where it was in October, November of 2022. And all of this is perhaps down to the fact that the People's Bank of China seems unwilling to support the stock market with stimulus efforts, rather preferring to defend the currency. A bit of a change today. Certainly you've seen the price knocked back, and they're talking finally about a big rescue package of sorts for Chinese stocks. Talking about using up about $280 billion in offshore funds from state-owned enterprises. Always helpful when you've got those lying around, to drive maybe a rebound in the Chinese stock market. If we're looking at the price here, USD CNH seeing quite a bit of a pullback, obviously, to say the least, since November, really being knocked hard because, of course, the change in the Fed's view. That's evolved a bit. You had, because it was arguably oversold down here in early January, the Fed suddenly sounding a bit more hawkish than it was, and those Fed minutes, if you remember, also in December, perhaps giving more hawkish tone than what we previously thought. And then with sharp drop towards the 50-day moving average. Again, declining 50-day, so we're on the cusp of a bearish crossover in the MACD as well. That could be very interesting for people expecting a more substantial move here to the downside. The big thing, of course, is to watch this zone of support around 71,130, because that was where support was found in June of this year, and then all the way through November and December last year. That also proved to be a degree of support for the index, so it could be interesting to watch that one and see whether it starts to get tested once again if we head towards trendline support from the February 2023 lows on this one. So definitely one to keep an eye on there. And then staying in Asian markets, dollar yen, of course, Bank of Japan doing nothing as expected. They didn't see the change policy, so the yen tried to strengthen briefly against the dollar, but a two-page statement of we're not going to do anything wasn't really enough to push the yen higher against the dollar. So dollar yen still firmly holding on to these gains, firmly holding on to a big rebound from those 2024 lows, the lows right at the beginning of the year. Still in uptrend, just about. This is what I mean. You've got that higher low. Yes, it was a huge pullback in November and December, but still above the July 2023 high. So you can tick the box for a higher low if you're still taking a bullish view on this one, as arguably you might want to. Nonetheless, after such a big move over the last few weeks, consolidation is the order of the day here. We'll have to just wait and see. You could argue maybe for a move back below 146 as bolstering a short-term bearish view, and argue this is a lower high. That'd be one way to view it, and then we'll see whether that has the strength to keep moving it lower. Very much depends now on what the Fed does, because as I said at the beginning, there's no Bank of Japan meeting until March, and they're unlikely to make any changes in policy this side of late April, if not later. So it's all now what the Fed says, and indeed potentially does if you do think a March rate cut is still on the cards, which seems unlikely. So definitely one to watch for here. If it consolidates and then starts to move higher, then you would expect it maybe to track back towards 152 and those November highs, where once again we can expect the fun of intervention talk to start. And then commodity markets, gold having a tough time of it, really. It's desperately trying to break higher, or at least try and recover from a pullback from late December, but it's not getting much of a break at this point in time. We thought it was going to earlier in January when we had the bounce off the 50-day moving average. It moved back above 2040, and then it was knocked back again last week. So a volatile time in commodity markets generally, but in the short term at least, the sellers still seem to be edging it really, and driving this one lower. After attempting to hold above the 50-day moving average on Friday, which would have been a good development to close out the week for those who are bullish view, it then dropped back again on Monday, and then we're still seeing some an inability to move above the 50-day as well. So some in the very, very short term, the last 4 days, some selling pressure developing around that 2035 mark. If you get a close above 2040, it could break at least this line and trend line resistance, so that would be a more bullish medium-term development. And looking at obviously the moving average, you've still got those rising, you've still got arguably higher highs and higher lows in the price itself, which tends to support bullish view in the short term. I think if you get a close below 2000, then it takes us down towards those December lows of 1980 and might start to put a real dent in that view. Once again, they put a full storm for gold, but certainly we'll again watch to see what this does with the US dollar in particular over the next few weeks. Commodity prices, oil continues to be the one that people expect to move higher, and yet it does it with great reluctance. Finally, you had a bit of a move here, up 2% yesterday, back above 78, closing above the 50-day moving average there as well. So if you're looking for reasons to be moving higher, then that is a strong one, because that's the first time we've managed that since mid-October. So I think in the short term, perhaps we could argue for that. If we looked actually at the weekly chart, I might want to argue that Brent appears to be bottoming out in a similar fashion. It does look a bit similar to what we saw in May and June of last year, before that rebound we saw to those September highs above 94. Not saying that will happen again in the same way, but certainly it looks a bit similar, that you've definitely got consolidation. What you've also got though, of course, in oil, and this is perhaps more important than even the direction really, is the fact that the volatility has gone up in oil. These big wide swings you're seeing, these long wicks, intraday swings, quite dramatic, is a sign that this market is making up its mind where to go. Buyers and sellers are really fighting this one out. It hasn't yet resolved into one way or the other, and could still go either way, to avoid sounding like a football pundit, but definitely at the moment there's a bit of pressure being felt on oil prices if you get a stronger dollar. So at the moment, maybe the buyers have just edged it with the upper hand for the time being. The close above the 50-day sends an interesting signal, although it's notable that recent rallies since December have really failed to hold the high. So there's a lot of work to be done, whereas, and if you could argue maybe for trendline support as well, holding this one up. Whereas if you're a bearish view, close back below 77.40, and then we'll break trendline resistance, trendline support, and also back below previous horizontal support too, and maybe could open another leg to the downside. But it is volatile in oil prices particularly, so do be aware of that if you're trading. Remember to keep your stops in place and maintain tight control of your risk management. So it is Netflix earnings day. You get those after the bell at 9 PM or so tonight, so do watch out for those. Fairly robust expectations for Netflix, so it's a somewhat high bar, I think, for the stock, and of course for the Nasdaq as well, and they're coming thick and fast from there. Expecting a bit of a cautious open on the Dow at best, really, coming off those record highs yesterday. So a quiet session probably ahead of Netflix earnings. But that's it for me. Thank you for joining us. We'll be back as normal tomorrow at 10:30.